Hi, my name is Bruce Bolger, and I'm the founder of the Enterprise Engagement Alliance, and we're dedicated to helping organizations apply a strategic and systematic approach to people across their organizations. And as part of that, we have a EEA YouTube series on CEOs and other leading organizations that are facing this issue either from the point of view of investors, business leaders, managers, or even, as you're going to see, valuation experts. And we have today here two people to discuss this subject of searching for alpha through effective people management. What does that mean? Really identifying how people, customers, employees, all stakeholders create value for organizations. Today we have Dave Bookbinder. He's Executive Director of Valuation Services for Haefele Flanagan, and they're leading, I should say, boutique accounting firm with a valuations practice. And Dave has been an advocate for this subject for, as far as I know, about a decade or more, and has written two books on the subject, one of which I contributed to, the new ROI, Return on, well, you'll explain that in the book. And then we have also Kristof Gleich, President and CIO of Harbor Capital Advisors. They are a leading investment fund that has taken the certain metrics to identify the human alpha, or the alpha of human capital in business. And so we're going to hear from him as well. And going to stop this share now. And Dave, I would ordinarily start with you, but there's some news from the happy ETFs that Kristof is going to explain. So Kristof, please tell us about the latest news about your funds, your ETFs based on human capital, and give us a little history of how you got into them.
Sure. Thanks, Bruce. Good to see you, Dave. So yeah, let me take a step back and just talk about the human capital factor, what it is, how we found it, and ultimately how we're offering it to investors to benefit from. So Harbor Capital, we're an asset management firm. We provide different solutions and different asset classes, typically actively managed, and really with the purpose of helping clients, advisors, individuals, people saving for retirement, build better, more durable portfolios by producing stronger returns and providing sort of different sources of diversification. And uniquely to us, we scour the world, and we work with boutique money managers that have a specific domain specialization, and they do maybe one or two things really, really well, and that we think would be valuable for our clients. And in this case, we partnered with a very creative research firm called Irrational Capital that has created the explicit link between the value of human capital inside businesses and the shareholder returns that owners of those businesses can expect to earn by investing in businesses that do a better job of maximizing the value of people. So at a very high level, that's what we do. And we partnered with Irrational Capital, and we now have 3 different ETFs. They're called the Happy series. So in ETFs, the tickers are very important. And so the first ETF that we launched, which was kind of the unconstrained version, is HAPY, or Happy. And then we launched a broader, more diversified kind of indexed version, which is also Happy, but with an I, HAPI. And then we also launched a small cap version because we saw that this phenomenon works particularly well in small caps, and that is HAPS with S, HAPS with S being for small cap. So we're live in market with these 3 ETFs that offer clients and investors a unique way to get exposure to the human capital factor through ETFs.
And we're going to come back to you in a minute or two to find out a little bit more about the methodology that Irrational Capital is using. And then you'll tell us about those results that were announced today.
Absolutely.
Okay, we'll get to that in a minute. Stand by. Dave, having written one of the first books on the return on individuals, right?
There you go. New ROI, return on individuals. That's the I.
And you are an accountant. And
no, never call me an accountant, Bruce. Some of my best friends are, but I am not an accountant. I'm a valuation professional. I've got a few designations in valuation. and an MBA in finance.
In finance. So the point
Yeah.
is, it's interesting that this vision of yours of really the new ROI came from the perspective of a valuations expert. How did that come about?
Well, as a valuation professional, I've valued people throughout my career. So people are an intangible asset, and we value them in the form of the aggregate, the assembled workforce. And it's done in the context of what's called a purchase price allocation. Another business acquires another company, and the intangible assets need to get recorded on the balance sheet at fair value. So one of those assets is people. And I won't get into the weeds on how it's recorded and so forth. But the long story short, Bruce, is that as a single dad, I sort of stumbled on the idea of what employee engagement felt like, because I got to work for some folks that led with empathy, and they treated me with respect and understood that maybe my circumstances as a single dad were a little bit different, and I would walk through fire for those people. And then during that same tenure, I also had a chance to work for some folks who maybe didn't quite get it, and maybe they didn't get my best stuff. And it occurred to me that the methodology that we were using to value human capital didn't incorporate any component of engagement or anything that I call the intangible within the intangible. So I was encouraged to write about it, and I wrote an article, and that's where I thought it was going to end, to be honest with you. But people kept showing up and telling me, keep going. And wound up collaborating with about 20 thought leaders from across North America to outline what became my journey to really prove that people are a company's most valuable asset.
And we're going to talk later about how much progress we're making. But getting back to you, Kristof, please tell us the news, the latest results, and then explain more about the methodology of how you objectively, or using the irrational capital methodology, objectively evaluate organizations based on human capital.
Sure. So if I take the sort of, the performance updates, we're pleased with the performance so far of the human capital factor. By way of illustration, HAPI, that's HAPI, on a year-to-date basis is up just over 12% net of fees versus an investment in the S&P, which is up about 9%. So there's some, good excess returns, or alpha, as we like to call it, in the industry. So let me talk a little bit, and it was interesting, Dave, to hear your perspective as well, and your personal story and anecdotes, and there's a lot to unpack there as well. So let me just sort of start at the very top. If you ask, I'm sure if I ask both of you, what is a business's number one asset, and the answer is, what would you say is the business's number one asset?
People, always.
Okay, and I think, you say it's said consistently across different industries, it's said across different cultures, different countries. We are all a collective of different individuals, and ultimately a business's value is unlocking the potential, if you like, and taking the potential energy of those individuals and essentially transferring it to kinetic energy for a form of output, products, services, innovation, and all of those kind of good things. Yet, Dave, if you ask one of your accountant friends, human capital, what is it and how is it classified on the balance sheet, they probably wouldn't say asset. They would say it's a line item on the income statement and it's an expense.
Exactly, so, salaries and benefits. Yep.
Salaries and benefits. So on one hand, you have us collectively and business leaders across the world that say the number one asset are people. And yet you have accounting on the other hand that says, no, hang on, this is an expense. So you have this sort of misclassification. And so we fundamentally believe that the value of human capital is not accounted for correctly. And in the business that I'm in, so look, I'm not an accountant by background. I studied physics at undergrad, and how I ended up in finance is a story for another day. But if you think about the business that we're in is trying to generate superior returns from markets, which is really, really difficult to do because markets are pretty efficient. And what drew me into this was really this notion that you had something that was misrecorded. Something that is misrecorded leads to an inefficiency. Something that is an inefficiency or an anomaly can potentially, with the right method and the right data sets and the right techniques, you can extract positive returns from that mispricing. So, one person's, accounting anomaly is another person's excess returns. And so that was the journey that we set out on about 3 years ago now, when we were thinking about bringing this to the marketplace. And, I believe that in order to produce a different return from the market, you have to look and be different from the market. And in order to do that sustainably well, you need to have an edge. An edge can come in many different forms. And in this form, it comes through really the intersection of the explosion in data that we've seen over the last 15 years, and also developments in behavioral economics and behavioral science, and our understanding of corporate culture and motivation. And it's really sort of, the overlapping, you remember those Venn diagrams from school? It's the overlapping area of those Venn diagrams that is ultimately the human capital factor.
And we're going to get a little bit more specific into that. But by the way, Kristof, congratulations. There's some real sound bites in what you said. Thank you very much. Because the bottom line is we're overlooking the alpha. We are overlooking the alpha because we haven't been able to measure it. And now there's a ton of data points out there where we can measure it to a degree. Dave, back to you. You and I have spoken a lot about this. What would it take, do you think, for I guess at the end of the day, it is the financial or the accounting profession to accept some sort of accounting for people as an asset? Is it impossible? We do know that there are going to be corporate sustainability reports that come along, right, with financial statements that will have a lot of the metrics, the new European law. For those of you who aren't familiar with it, the Corporate Sustainability Reporting Directive will directly affect thousands of US companies and force them, whether they like it or not, to disclose a lot about their customer and people management practices. But that's not going to be an accounting line item, Dave. Is there anything that could ever happen for us to better unearth the people to address this issue that Kristof raises? People are basically an expense.
Yeah, so from a technical perspective, the accounting world actually does classify people as an intangible asset, but they don't get a line item on the balance sheet. It's subsumed into goodwill. So to answer your question, I think the first thing is people need their own line item on the balance sheet. And earlier in my career, the assembled workforce was an identified intangible asset that had its own line item, but that changed and now it's just subsumed into goodwill. The second thing is you're not recording the value of the workforce of the acquiring company. You're only valuing the workforce of the acquired company. So if imagine a company that's got 10,000 employees. If they do no acquisition, there would be no value ascribed to the assembled workforce. So there's a big gap there.
Which is most companies probably, Dave, right?
Yeah. Yeah. So that's one of the fundamental problems, because you can't book intangible value unless it's acquired.
But then you can, though, correct?
But you're only booking the acquired business's workforce, Bruce. That's the rub. And then if you really want to drill into it, the methodologies that we use to do that is something called a cost to replace method. And it considers the direct cost to replace the employees. So for example, what would it cost to use a recruiting firm to find a replacement? What would you have to incur in terms of a learning curve? How many interviews would it take? How many people are involved in the interview process? So the direct costs are what is used to calculate the cost to replace an employee. And it works out being essentially a fraction of the employee's salary. So what it's really saying is that people are fungible. And one Bruce Bolger is the same as another Bruce Bolger. We can replace you tomorrow for somebody exactly like you. And it completely overlooks the intangible within that intangible. It's the level of engagement. Because I think we would all agree, everybody watching and listening here would agree that an employee who's fully engaged is more valuable than an employee who's disengaged. So I think we need to bake those components in. And I'm excited to hopefully one day partner with Kristof and my friends at Irrational Capital, because they're doing the work that I think can help me in bringing this to light more in the valuation of privately held businesses.
Well, we're going to get back to you, since we will have some time, on to what extent companies are missing value right now by using not necessarily official methods, but methods that could help But Kristof, I'm going to ask you to dig a little deeper into some of the metrics you look at. One of the things I noticed is that PE ratios aren't included, which I found very interesting. But secondly, well, please tell us what are some. Oh, the other thing I found interesting is you don't factor in customers, which I think are just as important. All stakeholders, but that's neither here nor there. So could you just tell us a little bit more about the irrational methodology, if you could?
Yeah, sure. And you're right. There's different research on sort of the value of customers as well. But this is exclusively focused around the value of employees. So let me just sort of start at the top. So the first thing that we look at and need is a lot of data. And so the process draws upon about 750 million kind of unique data points to put this all together. So when I said earlier that there's been a data explosion in the last 15 years that's made this possible, I really mean it. And the other thing as well in terms of the data is there is some proprietary data that we look at, and there are some public sources of data that we look at, and we marry the two together. And effectively what we're trying to measure, if you like, imagine trying to do like an MRI scan for a company's culture, and compare that to an X-ray. And then an MRI scan, you get much more texture, you get much more detail, much more nuance. That's effectively what we're trying to do at the corporate culture level. Now, the way that we do this is some of the proprietary data is driven from fully anonymized employee sentiment and engagement data. I'm sure you've filled these surveys out before. I know I have over the years. And the reason they're so valuable is because the same questions are asked in the same way over a long time period. Sometimes, 10, 15, even 20 years. And so we start with that data, and then effectively we have to try and organize that data into different signals. Now, you mentioned PE ratios. PE ratios is not one of our signals. That would be a traditional value ratio that a value manager would look at. What we do is we don't look at a single financial metric when we measure the human capital factor. So instead of looking at PE ratio, we might look at a different factor such as innovation. And so there are 7 underlying factors. I won't go through all of them. I'll just list off a few of them just to give your viewers a sense of what we're talking about. But how innovative is a company? Not how innovative they say they are or how they think they are, but actually what do the employees think of the culture of innovation at a company? And if you can systematically isolate companies that score much better on an innovation score, there's an alpha or an excess return signal in that. Other ones that I'll mention, direct management. What's the #1 reason given by people that leave their organizations time and time again? It's because of their manager. And so actually one of the pillars of the process of the human capital factor isolates direct management. What do millions of employees at tens of thousands of different businesses across the US think about their direct manager? How is organizational alignment would be another one. So there's 3 I mentioned: innovation, direct management, organizational alignment. And those would be an example of what we would call intrinsic factors. They're feelings, they're emotions. Dave, you mentioned something really interesting earlier when you mentioned empathy, and that I think you said you would run through fire for those people. Like, why is that? Now, if you think about motivation at the intrinsic level in the workplace, and I ask this question of journalists when I talk about this, because they're very intrigued about this process. I always say to them, how much less effort could you put into your job before you got fired? So if I just said, listen, whatever you do now, drop it by X%, and that you wouldn't get sort of found out for a year or so before getting fired. And the numbers range from, I would say, 40 to 80% is kind of what I've heard. And then so I turn it around, well, why don't you just do that? Your contractual obligation is, you should just, you're being inefficient. You're working too hard. And the answer is because there's something special about that organization. There is an emotional connection. There is a sense of purpose. There is alignment. And there is something unique about the culture that gets the best out of people, takes that potential energy and turns it sort of in, if you like, into the kinetic. And we're trying to take a very empirical, data-driven, tangible process to measure what is ultimately intangible. And we partnered with a gentleman called Dan Ariely, who is a very famous behavioral economist. He's a sitting professor at Duke University, and he's written, many, many books. And I think in a way, his role in all of this is kind of the Rosetta Stone, and it's translating that data into the factors that are important, because he has become an expert in understanding human motivation. He has an incredible personal backstory, but his skill set in life is understanding what motivates people in the workplace and using him.
I'm going to stop you right there, because I'm going to give you a chance to expand on that in a minute. I'm going to.
Okay.
So, Dave, in your point of view, I've been experiencing so many mergers and acquisitions in my life, and most of them have failed. Many of them have failed. I've also seen many private equity companies buy companies, and they fail. I worked for an employee-owned company that had double-digit growth for 85 of its 90 years, and within 6 years, it was gone. So my question to you, Dave, is how much far along are we still in really turning a blind eye onto everything that Kristof and the people at Irrational Capital and Dan Ariely are telling us?
I'm optimistic, Bruce. I see the glass is half full. I think there's a movement afoot here. I think private equity has even gotten the message. Yeah, they've gotten a bad reputation over the years, but I think they're starting to understand that the last bastion of value creation really is human capital. So I'm optimistic about that. Getting back to some of the other things that we were talking about, because I think it's important to note that my lens is that I don't think that modifying how we change the workforce is going to matter until we get people on the balance sheet. So my lens really has been, yes, there's a way to do it better. Yes, I've got some thoughts on that. But until we have a line item, nobody really cares. The focus around the new ROI, the return on individuals, is really about the people's contribution to the enterprise value. And valuation of a business is essentially the present value of its future economic benefits brought back to today's dollars at a cost of capital. And the research that I've done indicates that the companies that are doing the right things around their people that would have, in Kristof's language, a really positive human capital factor score, those companies enjoy a lower cost of capital. So the way the math works is all things equal, right? The lower the cost of capital, the higher the valuation. So I would love to find a way to bring that construct into my world in private company valuations. And I'm thinking that, and Kristof, you're going to have to help me with this. Hopefully someday we will officially, but I envisioned actually something ironically called the human capital investment factor. I had hypothesized that in my earlier work, that it would be an adjustment to the discount rate based upon some correlation of public data and performance based on companies that are doing the right thing. But there's also maybe an opportunity to think about how a human capital factor score could be applied as either a discount or a premium to a market valuation based upon levels of engagement and the human capital factor score. So I would kick it back to Kristof, and we don't have to have that deep conversation here, but we'd love to at least get an initial response on, does that make any sense?
Yeah, it absolutely does. And so, look, where we are in the sort of the journey of human capital, and we're trying to create awareness that this is something that is fundamentally not accounted for correctly. we think the best way of demonstrating that to our investor base is through, demonstrable excess returns by investing in the human capital factor. And that's a very kind of if you like, moralistic way of buying into this, if you needed to, just sort of doing it through, if you like, the hard and fast cold numbers. So that's where we are. But what are the different applications of this? You talked about a couple of interesting things there. One of the services that Irrational Capital are working on is if you like, a ratings, almost like a ratings agency service for human capital. So where you can go to a business and engage with that business and give that business a tangible score, like a human capital factor rating. And if we can create a new standard and think of this as like, an S&P bond rating, right? Let's just go with that, AAA down. If you can create something equivalent for the human capital factor, which is ultimately, I think, where this could go, then the economic benefit becomes even more real through, okay, what is going to be the average credit rating of a business with a AAA human capital factor versus a C human capital factor? Well, that's going to start creeping into, funding costs. And then, whether it's cost of debt or cost of equity, effectively, you're going to drive down cost of capital, which is then going to further, I think, accelerate, the impact that human capital factor can have. So that's the first thing I would say on that. And Bruce, you mentioned, private equity. Look, every time a PE firm goes to look and buys a business, there is some form of, leadership evaluation, but it doesn't go deep enough. And with the data set that Irrational Capital have, this is available for private and publicly held companies. Setting up a service for private equity sponsors to get a human capital factor rating of a business, which goes from the C-suite all the way down to the rank and file, is going to be incredibly valuable, for private equity firms and private equity sponsors. And we're at the initial kind of beta testing, as you guys say around here. So I wouldn't be surprised to see that take off pretty significantly.
Well, that's really,
and Bruce, if I could just add one more layer on top of what Kristof just said, depending on where you get your data, regardless of whether it's a private equity deal, about 75 to 90% of M&A transactions fail to deliver the prescribed synergies, that 1 + 1 = 3 piece that leads companies to do these deals. And the number one reason that I keep reading for the failure is the integration of the cultures, the people. So I think, to Kristof's point, it's really the key to the value creation and value acceleration in all these deals.
Well, what's really exciting here is we're getting a hint, really, of where the answer to this question is. Kristof, you're giving it by saying perhaps there's an objective means of creating a bond rating system, the equivalent of that, right, with sufficient data points, right? Secondly, then, Dave, you're saying we could then apply that in valuations to future discount. Why don't you quickly, because I'm going to leave one last question to Kristof about the how. So Kristof, you're going to have one last big one. But Dave, from your standpoint, just because I'm not technically, explain again, what could we do potentially if we had a rating system that was accepted as, as objectively as the bond rating systems, which aren't perfect either, right? Okay, but as good as that, where you could basically take that as either a discount rate or a risk. What would that look like in a layman's terms, if you can do it, in adding a line item to the balance sheet for people?
Yeah, I'll dummy it down for the audience, but for the valuation professionals that are out in the audience, they'll tell you that unless it affects cash flows or a discount rate, it's voodoo valuation science. So I'm going to throw out the idea, the notion that maybe there's a discount or premium to apply here. I'm going to go straight to the discount rate. And again, I emphasize that these good companies, the just companies, the ones that are in Kristof's funds, they're enjoying a lower cost of capital. And there's some correlation between what their performance is around human capital and their ultimate cost of capital. And if we can make that adjustment to the discount rate calculations that we're using in private company valuation, I think that's the home run.
Well, so Kristof, you have the last question. Your company appears, and I know you have a CEO that you work for, but you're the president and CIO, that your company is dedicated to the same principles itself. It appears on your website that you, for your own employees. And so I know just you're gonna have to give us an elevator pitch, but I could do it, so I'll give you a chance to explain, because I just went to a great conference, the Purpose Summit in Charlotte, all these CEOs and business management. Yeah, I get this. And you know what they're all saying? How? What does this mean in practical terms? Okay, now I got to go. How does that affect HR? How does that affect my purpose statement? How does it affect marketing? How does that affect sales, logistics? What does this mean for me? So I'm going to give you a chance, and just as the last question, do you guys have any kind of framework that you apply, or if you had to explain it real quickly with a CEO in first class, how would you explain it?
So look, we're very proud of what we've achieved at Harbour Capital, and nationally we've been recognised 3 years now in a row as an employer of choice, which is really gratifying. And look, what I'll say is it's a never-ending journey. I don't want to say that we found kind of like the secret sauce and we've got it solved. And some of it is, I would say, look, culture starts at the top, but it's built from the bottom up. And our CEO Charlie McCain sets a real culture of respect and honesty and trust. I think trust is probably one of the most important aspects for unlocking human capital and a superior culture, and it has to be real. You have to live and breathe trust through actions and not just kind of words spoken. And I think if you have that, it's an oxygen for the entire company to not just survive but ultimately thrive. Other things as well that I've learned through this research and reflected on my own journey as well. I've mentioned trust. I think another one is psychological safety. Psychological safety is a term 20 years ago I'd never heard of, and probably 10 years ago I'd never heard of it. But it's this notion that there is, no idea is so out there that you can be mocked or ridiculed for, putting something ridiculous forward. And I think, in a way, a lot of large organizations, they'd rather sort of fail conventionally by doing the same thing that they've always done. And yet one of the things that we treasure and try and install here is this notion of, psychological safety. And that just allows people to be their best and their truest self. I remember struggling with this in my, more formative years. There was kind of a work version of me, and there was the social sort of outside of work version of me. And I don't think that's really sustainable. And so you want to have an organization that attracts people where they can just be their true selves, their one self. And I think we spend a lot of time on that, just sort of talking about it. And then, finally, I would say communication, and just having a sort of a culture of communication is really, really important as well. So hopefully that's given your viewers a few different sort of takeaways.
Well, and I didn't ask you to do that either, but you know what it really proves? That where this movement is coming from? It's coming, ironically, from two different places that are converging. One of them is the heart. The founder of your company believed in his heart that he could only succeed if his stakeholders really believed in the vision, right? But it's not taught in schools. He didn't learn, I guarantee, unless he went to Darden, University of Virginia, Darden, or maybe he took Harvard now has a new program, believe it or not, on stakeholder management. But they are very early stage. I'm not even sure they have a clear definition for it yet. So I love the fact that your company is bringing together the analytics with the heart, because that's what this is all about. And there are a lot of headlines on this, folks. So what we always do is we summarize these articles. We summarize these shows in an article, as well as put this up on our YouTube channel, which we're going to do. But there's some big headlines here, gentlemen. Putting it on, making people a line item on the accounting sheet. What you've talked about, Kristof, about that alpha without taking into account PE or financial factors is extraordinary. And there's a lot of other headlines you'll see in the article. So, gentlemen, thank you so much for your time, and look forward to more EEA shows on this subject.
Pleasure to be
Thank
with
you.
you.